audit report, everybody's seen a copy of it. So without holding anybody up, I'm going to turn this, delaying any further, I'm going to turn this over to our controller.
And I'm simply going to turn it over to Tim Thomas. Tim's the managing partner for Toski, who's audited us now for twice, 2 years. You have PJ in the back, and Cassie in the back. And I'm going to project whatever statements that Tim's going to go to, and we'll just get right into it.
Great. My name is Tim Thomas. I'm the director at Toski Company. I'd like to thank you all collectively for hiring us to do this work for you. It's something that we take very seriously. I know that we don't get to meet with you folks that much, but at the end of the day, we are accountable to you all as a group for what went on. And I'm here to tell you about 2013 and to answer any questions you might have. If any of you have any questions, please just feel free to stop me anytime and see what we can do. We have a draft of the 2013 financial statements. First thing I want to call your attention to is start right on page 1. It starts with our independent auditor's report. And what you have engaged us to do is express an opinion on your financial statements. And in an audit, we try to get to the point where we can say that your financial statements present fairly your financial position and results of operations. Fairly is a hedge. Admittedly, it's a hedge. And the reason it is because we made a whole bunch of estimates. There's accounts receivable in there. We think that what shows up on your statement of net position and your fund balance sheets in terms of receivables are what is ultimately going to be realized. The only positive guarantee I can make you is that number's wrong. But it's not wrong by enough to cause anybody to change their mind about anything. That's why we say present fairly. In the old days, we never took responsibility for fraud. We tried, and then we tried some more as a profession to run away from having any responsibility for fraud, but it didn't work. So we ultimately assumed the responsibility that everybody thought we had anyways, and we looked for fraud in the course of doing our audit. Had we found any, we would have spoken with Mr. Bratton as your chairman, and because we didn't, that means we didn't find any. What we're looking at, okay, we have our auditor's opinion on your financial statements. And basically, we have given you 2 types of opinions. Your financial statements consist of governmental funds and proprietary funds. I know, 50-cent words. Governmental funds are all the things, are used to account for all the things that you do as a regular government. Proprietary funds are the things you do that are kind of like what a business would do. Time Haven is the proprietary fund and the solid waste fund. Now, we gave you a qualified opinion on your governmental funds. The only reason we gave you a qualified opinion is because the task, the Tobacco Asset Securitization Corporation, is required to be presented in the governmental funds. You don't present it that way. Quite frankly, management feels that to include that entity in the governmental funds distorts the financial position of your county, and we agree. Unfortunately, the people who set the standards don't agree. Now, it's really ironic because back when all those tasks were formed, they were very deliberately created in such a way to push them outside of the scope of your county and accountability. And subsequently, it was determined that it didn't matter. The reason it's important and the reason that management felt that they wanted to show them outside of the governmental funds because there's a whole bunch of debt there that is non-recourse debt. They felt strongly enough about their position that the last page of the financial statements is a copy of a letter from your bond counsel saying that it's non-recourse debt. And because that presentation isn't in conformity with professional standards, we have to qualify your opinion. That's the only reservation that we have about anything. Everything else in here is an unmodified opinion, and that means that where you had a choice for the different ways you could count the beans, you picked the most appropriate choice. Not really. Interestingly enough, the only place it shows up is in your governmental-wide financial statements, and we'll talk about that in just a second. But the bond rating agencies know all about those tasks, and they basically, the first thing they do is disregard them. But the concept is, and there's two sets of financial statements in your financial statements. There's a governmental-wide financial statement, and then there's a fund-basis financial statement. Now, if you don't understand that, that's okay, because half of the guys that work for me don't have a clue what we're talking about. And what it boils down to is this. You prepare a budget based at the fund level, and let's pick the general fund as an example. You prepare a budget every year and you adopt it for the general fund. In that budget, you're worried about generating enough cash to fund the operations of the county for the calendar year. So we maintain and report on those fund level financial statements on what approximates the cash basis. That doesn't do a very good job of necessarily showing where your county's at. It's important to you all collectively because you need to make sure that you're raising enough money to fund the day-to-day operations of the county for the year. So that measurement focus is really important for you. But we also do a governmental-wide financial statement, which basically makes your financial statements comparable to a public entity, like General Motors, for instance. And what we do to get from those fund statements, which don't have anything that's not current on them, is we add all the stuff that's not current. We add in all the fixed assets. On the fund statements, if you go out and you buy a new truck in your highway department, we expense that whole truck. On the government-wide financial statements, we back out that expense and show it as an asset. If you issued in January $12 million worth of serial bonds. On a fund statement, those show up as revenue. We never recognize the fact that there's an obligation, and then the annual principal payments on those show up as an expense. Well, when we do the government-wide financial statements, we pick that up as a liability. Now, interestingly, go ahead.
This is GASB 34, people, okay? 2003, these standards went in place. All of you should be on GASB 34, all municipalities. But it's just the larger municipalities that the task was taken to. Because the larger municipalities are the ones that have to go out in the bond market all the time. So when you look at governmental funds, it's basically a cash basis fund with some sort of modified accrual, which all you are familiar with. And when you look at the government-wide financial statements, that is where you get into GASB 34, when you have long-term debt depreciation, property, plant, and equipment, and all those sorts of things that you would see in a GE or a Sears Corporation. And there is a reconciliation in financial statements that takes it from government-wide down to your fund statements to where your cash is. So you really want to focus on the government-wide financial or the fund statements.
Yeah, fund statements are really what's most important to you. Following our opinion is a narrative section. It's kind of like the Reader's Digest abridged edition of what happened. It's kind of like a high-level review in narrative format of what happened for the year. And basically, we talk about all the significant changes that happened. The big things that happened this year that were major changes were you have a promise to your retirees that they're going to receive health insurance from the time they retire until the time they die.
Well, yeah, 45.
Okay, 45. The other word they use is OPEB, your other post-employment benefit obligation. Sometimes we call it other post-retirement, but that usually means post-employment benefit obligation. And that's an actuarially determined number. And each year that an employee works, he earns an incremental amount and the liability goes up. This year, that liability jumped between Pine Haven and the county itself, $7 million because of healthcare trends and Obamacare. That shows up on the government-wide financial statements. Now, if we were to jump over to page 15 and 16, we'll start, we'll go to 16 first. No, just let's go to page 16 first. Which one next? Page 16. There you go. We're looking at other post-employment benefits liabilities in the governmental activities. It's $24,436,800, and then in the business type activities right next to it, there's another $6 million. That's Pine Haven and the solid waste fund. Solid waste, there's not a lot. He's one there. The big thing is when you look at the bottom, if we were to scroll down and look at the equity, we call it net position. But if we were to look at the equity from the governmental-wide financial statements, in your governmental fund, you have just about $3 million worth of net position. That's not very much. You got to keep in mind that in there is that $30 million liability for the OPEB obligation. You're not going to pay that today. You're not going to pay that tomorrow. That's something that's going to get paid out over the next, however long your youngest employee that's already here. So maybe 30 years or 40 years, you're going to pay out that $30 million. There's no receivable on there for the taxes that you're going to raise on an ongoing basis to pick that up. Now, pardon me?
How much of an increment on the yearly basis
You recognize the amount that you pay out on an annual basis it's done on, they call it a pay-as-you-go basis. So as the premium, or in this case, as the premiums are required to be paid on the retirees, it becomes an expense in the current year.
So Bill, on an average year, we pay $10 million in healthcare premiums between medical and drugs. And that's your pay-as-you-go. And that's the whole concept of this thing is we pay for our employees' health insurance today. And that cost is $10 million a year. Now going forward, this number might go down a little bit because we went with ASO self-funding, which will definitely reduce our benefit going forward.
I guess the big thing to take into consideration is these financial statements, while they're required, tend to lose their relevance because you've got that big elephant in the room liability for that OPEB that really is not even going to turn around and be a claim on cash in the next 10 years even.
Question on
In the component units, there's an $18 million loan number, and that is the bonds on the tobacco.
That's the class we talked about in the beginning.
Those are non-recourse bonds. What happened with those, and I'm not sure just how familiar you are, is when they had that master settlement agreement, counties created these corporations and basically sold the future stream of earnings in exchange for a bond, and basically got the cash now. And they're ostensibly junk bonds. And the theory is, so long as people continue to smoke, they'll generate a tax that will come back in an annual settlement to you that will be used to pay those bonds. If everybody in the world stopped smoking, and this is an important concept, and this is why they were adamant about it being shoved out there. If everybody in the world stopped smoking and you never got another dime, it would not hurt Columbia County one bit because there's no recourse. The people that bought those bonds are out to lunch. They lost. Now, chances of that happening are way beyond me. Yeah, now let's go to the fund basis statements on page 18. This is the balance sheet. And this is really where things start to come into relevance for you folks. That's where things start to come into relevance for you collectively, because when you're looking at your general fund, you've got a fund balance of $14 million. That sounds like a lot. There's about $4.5 million worth of cash, which sounds like a ton of cash. That sounds like an inordinate amount of cash. If that was in my bank account, that would be a lot of cash. Unless my wife knew, then it wouldn't be there forever. But if you were to compare that to what you spent in operating expenses for that year, the operating expenses were $109 million. So $4.5 million is way less. It's about 2 weeks worth of operating cash. So that's kind of light. Now there's two things that we need to know when we look at that number. First thing, it's bigger than it was last year. Why? In 2013, you all collectively made a decision that you needed to encourage people to pay their taxes. So we were actually here doing the 2012 audit when this push started to go on, and all summer long your business office made payment agreements and collected taxes, and the tax receivable number went down from 2012 to 2013 by about $3 million. So that's $3 million more cash that came in the door. Now that number would have been significantly larger, but for two things. First of all, you're building a courthouse that you're spending a fortune on. If you look at the receivables on page 18, in the general fund, there's $7 million worth of receivables from other funds. There's about $3.5 million of that relates to Pine Haven, a big chunk of which you got back when the IGT money came in 14. And there's about $1.9 million that relates to money that you put in the capital projects fund to pay for the courthouse. Now, the IGT money came back, and in January you issued the serial bonds, so some of that money should have came back. Bottom line is, you're doing a lot better in there than you were in the prior year. And your cash position is greatly enhanced.
One thing I want to say too, that we showed a profit there of $2.4 million. You see that? That's a profit in the general fund of $2.4 million. Although we collected $393,000 tax, that has nothing to do with P&L. All we did is change an asset from a balance sheet account called account receivable to cash. Not confuse collecting $3,390,000 of back taxes as profit. Am I correct?
Pretty much. Bottom line, I have a client that there's a guy that's a farmer, and he's been a farmer for 50 years, and I figure anybody that can be a farmer for 50 years has got to be doing something right in this day and age. And he always asks, so are we doing okay? And no matter how much I would talk to that client, at the end he says, so are we doing okay? And I guess the question the answer I would give you is yeah, you're doing okay. You've got aggressive in doing a lot of things, and the economy's not good anywhere in New York State, but you're doing okay. Your funds are doing a lot better.
Yeah, one more thing to point out too, we're talking about, these are fund statements, not slide statements. You look at the capital projects, they're showing a deficit of $8.9 million. That's because we got the cash for we borrowed that in January of this year, we got the $12.5 million. So when they go into 14, you're going to see a big pop there.
Capital Projects Fund is going to go positive and negative, and it's going to flop everywhere. It depends where you are in the cycle of a capital project because we're on a cash basis. That's not something that you need to be terribly concerned about. And whenever you are in a significant building project, you're going to see those kind of flip-flops. But when you look
$1.5 billion
at
of that fund now, county roads, you see that, but
Borrowed $1 million for paving, remember? We borrowed another $500,000 for equipment, another $100,000 for solid waste. So you're gonna see that in 14 is gonna turn around. It's just time and cash.
$2.4 million sitting out of cash.
well, I say you're doing better. 4.5.
2.5 is the problem. No, 4.5.
You're- But you got to keep
The question
it.
is, you're saying you're doing okay. What would our goal be? How much money based on a budget that large?
Realize, can I answer that? Our treasurer who pays the bills every day and moves his sleep and the tear drips grayer says $10 million.
You had $109 million worth of expenses in the general fund last year. If you divided it,
10% of that?
if you divided it by 12, you know, a month's worth, and if you did the math, and I did it just to see what it would be, and it came to like $9.16666 million. So basically, between $9 and $10 million cash would give you enough cash to have a month's worth of operations and not have to rob Peter to pay Paul to make the bill.
Okay, to me, it's not okay. I realize.
Well, I mean, relatively.
Counties are in.
Right, relative to where you're going the right direction.
You gotta remember this, at 12/31, I think over the county $3.5 million. That wasn't there, our cash position was
And there was $1.7 million that was owed from the capital projects fund, so you'd have been right where you would have been right where you needed to be. And you got there. I think it's important to know that you got there deliberately because you collectively as a group made a conscious decision that we're going to go out and chase these people and provide alternative strategies for them to pay their taxes. And you collected an additional $3 million worth of cash, which is a big deal. That's a big deal. That was huge. And that was all entirely attributable to that. Now, when we get behind those pages, there's some reconciliations that explain how we got from a fund balance for the governmental funds of $6 million to a net position on a full accrual basis of $2.9 million. And there's $40 million worth of capital assets that aren't on the fund basis statements. They are, but they were expenses as you purchased them. They're assets. We put them on there. There's almost $10 million worth of bonds payable and stuff like that we put back on. The other post-retirement benefit obligations for just the governmental-wide, the OPEB one, GASB 45, there was $24 million. Compensated absences, $3 million. Your share of the workers' compensation liability at the end of the year because you're self-insured for workers' comp is $8 million. Now you might say, holy cow, $8 million. If a guy falls down and gets hurt today on workers' comp, the actuaries figure out how long he's going to require whatever kind of care that injury is going to take, and that becomes a liability today. So that $8 million is kind of like that GASB 45 OPEB liability. You're going to pay that over an extended period, and it's not an immediate claim on cash. And it's based upon estimates. Now, that's something that I think merits a little bit of comment is the GASB 45, the OPEB liability, and the workers' comp liability are actuarially determined. We look at the assumptions that they used to make those actuarial determinations, and you can push those numbers wherever you want to push them. If you start monkeying around with rates of return and things like that. your management didn't do that. I think that's important to know, because you can, when you got a liability that's as big as some of those are, if you change a rate of return 0.5%, you can make a big swing in what that liability is. And no one really notices. You didn't do that. Your guys did not reach out to the actuaries and cook the books, if you want to use that terminology, which I think is important to know. And that's something that, had they done that, we'd be here telling you that, you know, we think you're a little aggressive with some of the assumptions that you used. That didn't happen. We're not telling you that. Following these basic financial statements are summary of accounting policies, and basically what that is there's choices in the way you can account for things, and where there are choices, we tell whoever's reading the financial statements, this is the way they did it. We don't have any problem with the way they chose to do things. Following those are some illustrative notes. The disclosures that are in here are all required disclosures. We think that they're all fair and reasonable, and I think that the term we're supposed to use is neutral. This isn't where we take the opportunity to go all Edgar Allan Poe and create, you know, a whole bunch of additional